We're doing a segment on losing streaks, underlying versus options. Let's go to the first slide, Beth. Even high probability option traders take an occasional loss. That's for sure. Over the long run, however, we do expect to profit. For a retail trader, the biggest danger to being able to stay in for the long run comes from consecutive losses. Previously, we've considered how frequently consistent short option positions resulted in serial losers, but recent market behavior has led us to narrow our field of vision. How often have short option positions racked up large losses several days in a row, like the last couple of days?
So they're just looking at short option positions versus long stock? I mean,
short option positions. Well, I'll show you in 1 second.
Okay.
So how often have short option positions racked up large losses in several days in a row? Because Thursday, Friday, Monday were tough. Let's go to the next slide. So 20 years of data, and we use SPY in this case. And we considered holding the SPY shares, selling strangles or selling iron condors, initiated 60 days to expiration. We examined occurrences of large down moves defined as more than 1% of the previous day's closing prices. For option positions, we contrasted the rates during 60 days to 45 days, 45 to 21 days, and 21 days and in. All right? Let's do it. So we have all the different time frames covered. Over 20 years, the SPY had 3 consecutive down days about once a year. Does that surprise you?
Yes. Surprise you?
3 consecutive 1% down days. I'm sorry, not down days.
Yeah.
3%. 1% down days in a row happens about once a year. Now, this was crazy because this was almost 5% 3 days in a row, which is really insane if you think.
Which I think happened like
four times in 20 years.
In 20 years, right?
Yeah. So let's talk about what this meant. Just, this is only 1%. So we looked at shares, then we looked at straddles, 20 delta strangles, short 40-20 iron condors, and short 30-20 iron condors. So the frequency of 2 days in a row, 3 days in a row, and 4 days in a row, you can see of your shares being down 3 days in a row, 1% or more in the SPY, it's 2% of the time.
Yep.
If that's 2 days in a row. 3 days in a row is 0.4%, and 4 days in a row is 0.1%. God, that seems so low, but it is what it is.
It is what it is.
And
the
straddles are about the exact same as stock. Strangles, a little bit greater. Iron condors, a little bit greater, but really all kind of the same. There's not that much difference between all these numbers.
Yep.
And so when you look at it, what are your chances of, if you bought, let's say you bought 100 shares of IBM, well, your chances of being down, 4 days in a row of 1% or 3 days in a row, 1% is 0.4. If you sold strangles in there, the chances of being down, if you sold strangles, iron condors, or straddles, your statistical chance of being down 3 days in a row for 1% is pretty much the same. Let's go next slide. So then we went to the 21 days to expiration. I'll go back one slide. The last one was the overall, right? So now we're going to break it down to different expiration cycles. So the 21 days to expiration, this is the scariest part for us, is 21 days and in. And you can see this is when your numbers explode.
Yeah. Yep.
When you get 2 days in a row frequency, 3 days in a row frequency, or 4 days in a row frequency, it's significantly higher than it would be for, what we just looked at a minute ago.
Yep.
In the overall space. So this is not healthy. 21 days in. This is why we manage a 21 DT.
Yep.
So let's go to the next slide. This is what we do, 45 days to 21 days. As you look right here, these numbers are very similar to the shares themselves. So the consecutive 3 days in a row, 2 days in a row, or 4 days in a row are almost identical to shares outright. So if you want to know why we we close or manage the trades at 21 DT. Just look at this slide and go back one slide, Beth. These are like 6x to 8x of what the next slide is. Go forward, this, which is 1/6 essentially the amount of times, which is crazy because this lines up very closely with the actual stock. If you go to the next slide, which is longer, this is going to be less because you're going out as far as possible. This one, there's nothing wrong with this, except it's really hard to make money. Because between 60 and 45 days, it's just tough to make money. There's not a lot of in there. There's not a lot of juice. But I think it's unfair not to show you this. We don't go out this far, but if you have to, you're going to take a lot less risk. So the bottom line is the further out you go, the less risk you take. But if you want the sweet spot, it's 45 to 21. But if you want even less risk, you go outside of 40, 45, go to 45 to 65 or whatever it is. Let's go to the next slide. So these are some of the takeaways. Overall, short straddles and wired iron condors had very similar rates of serial 1% down days as the underlying itself did. The out-of-the-money strangles were slightly more streaky, while narrow iron condors were slightly less streaky. Near expiration, option positions pose significantly more risk than simple shares. That was my big takeaway from that third slide.
Sure.
Looking beyond 45 days, option positions were actually somewhat less prone to streaks than the underlying itself. And contemporary volatility, if contemporary volatility is more turbulent than you like, rolling expirations further out in time can lead to option positions, especially defined risk positions with fewer serial large losing days.